and what solution to accumulation and distribution phase, schematic or transition. So please watch this video. It would be a very long, like eye-opening video for all of you because many traders fall into this particular trap when they are following Richard D. Wyckoff study or method. They fall into try to implement things in a try to apply schema like let's say every time frame, and they end up and losing their confidence and money when it comes to trading Wyckoff. So just give me a minute. We'll start. So the first thing which I would like to explain is like there are two schematics in this on this in this window. One is of accumulation. Sorry, this is of one is of distribution, and another one is of accumulation. So I hope everyone who is watching this video understand what is accumulation and what is distribution. Let me just give me a minute. Let me set up the solution to explain things. Okay. So on my right is so what is accumulation and distribution? I'll try to explain you in a simple way so that after this video you would be in a better position to assess, or at least you would be in a better position to define what is accumulation and distribution. If I'm telling you this is a distribution phase, a distribution taking place from this particular point to this particular point of price, starting from this particular uh, price action, ending at this particular price action. So if this is distribution, what exactly Wyckoff, what is the meaning of this schematic? First thing first, this is preliminary supply, prices coming down as we are approaching upwards. Then we have a buying climax kind of thing. Then automatic rally or automatic reaction. Then secondary test. Then test. This defines as soon as there is a first test that defines phase A, and whatever happens within after phase A and before upthrust, you can say upthrust after distribution is defined as phase B. Okay, and in this phase, there would be multiple tests, or there would be a like more than 2 or 3 day test. It depends. This is some technical analysts and some tutors. They define once the upthrust UTAD means upthrust after distribution occurs. That defines phase C, and after UTAD, we get uh, high momentum price movement towards the downward side, or that it would be the support. And this defines like, and after that, we get a breakdown, and then we breakdown of the creek, or what you can say, um, sign of weakness. This is called as ice. There is an analogy of like falling through the ice and jump across the creek. That is a different analogy that some of the contributor of like after Wyckoff they have come up with to understand what is they mean by breakdown and what they mean by breakout. So this is last point of supply or last point of support, whatever you want to name it. And then after that we see a markdown, which is normally in today's era we called it as downtrend. Okay, to simplify this thing. So what is actually happening at this page? What is the problem? Why does this schematic fail? Why does every trader fail in identifying or assessing the market? Because this is something very not practical. The reason being said is like if you consider this to be a chart of distribution, wherein a chart of like we can say 1 hour. For example, you can take 4 hour of daily, 5 minute, 1 minute, any time frame. So normally what people try to do and like normally I'm not naming any tutor, I'm not calling any tutor by like what they are doing or what they are teaching is wrong or this and that. I'm not the person to judge their way of trading. What I'm saying which doesn't resonate, which did not resonate with me, that means it is which I found to be impractical, not consistent in nature. That is the reason I'm recording this video and communicating it to all the traders because I'm a Wyckoff analyst and I like to trade based on Wyckoff and I like to trade and preach Wyckoff. So I want what is the true what to my best understanding what is the true essence of Wyckoff to be communicated to the people who want to learn and who want to earn consistently based on Wyckoff methodology. That's my sole objective. I'm not here to sell my indicators, not my methodology because I'm doing like I'm a trader first of all. After that, after my trading and after all this thing, I want to communicate and pass the message that I have certain things which works like anything. It works on any damn good time frame. It works on any uh like any market and any which is like any instrument which is fairly and freely traded. Okay. So having said that, what as per the topic of today's discussion, is why this thing fails when it comes to distribution or when it comes to accumulation, why this thing fails. The reason being said is like if you're considering this to be a 1 hour time frame. So if I'm considering this to be a 1 hour time frame, for example, this would be a detailed video. Please watch this video till end if you want to learn and if you want to understand what is my point of view based like on Wyckoff schematic phase analysis. So what happens when you define a phase based on one particular time frame? What is happening in all these moves is like price is getting accumulated and distributed simultaneously. So now what you're trying to observe is on 1 hour time frame or like for our example, I have taken 1 hour time frame. So you are doing what you are trying to identify is based on 1 hour time frame. And what normally a trader does is like who is learning Wyckoff schematic is like they try to apply it on one time frame. Either they come down to lower time frame or either they switch back to higher time frame. Like in this case, you're doing analysis on 1H, okay, or H1. 1H and your lower time frame would be either 5 or 15 or 30 and so on. Or even some traders go below 5 minutes, like 3 or 1 minute, just to by doing the analysis on higher time frame. Like if we are in a phase B, that means it gives you an what you can say of a bias that their price at least would reach to secondary test level. Okay. If not, if we are in phase A, that means we are as soon as we appear see a buying climax, after which is followed by a preliminary supply. So we would get an automatic rally that too on the lows of like for example in this particular schematic it is we are like the distribution has started from the or you can say the snow or the ice sort like the ice has been drawn from this particular point of like you can say price level. So there are many counter trend and many trading ways to trade this market. But what happens if you're coming down to 1 hour time frame and if you're following 1 hour time frame schematic? That means you're planning a trades around this particular levels. If not, this would be the first case. Second case would be you would be doing the analysis of this entire phase, and after you see a sign of strength, and if you see a U-Tart, and then you see a last point of supply, and if you see price coming back and touching the snow or the ice, and it is it has started moving downwards. So either at this particular point you will go down to lower time frame or either higher time frame, and you would initiate a trade. This is your analysis time frame, 1 hour. Lower time frame would be 5 minutes, 30, 15, and so on. Higher time frame would be 4H or 1 day or so on. So these are the two ways to trade. Very simple and straightforward. Don't get into what you can say uh, complexity of this thing. This is one way. Second way is you're doing your analysis on one edge, and if, for example, price is here trading here, or price is trading here, or price is trading here, anywhere within this range, you identify this is the top and bottom range of the particular price level, particular price of this particular instrument. So you would rather look for a schematic of on lower time frame on this particular thing. This is a common thing which normally trader does. They identify higher time frame schematic. If this is the case with distribution, they then drop down to lower time frame. That would be, I'll consider 15 minutes, for example, 15 minutes, and I try to identify accumulation or distribution here. So now here is the catch. What normally happens is like trader is identifying accumulation and distribution, or has defined distribution or accumulation, or is in the process. Like for example, we are in phase B in H1, and in 15 minutes we are in phase C. So now what would be your bias? Your either price is trading here or trading here or trading here or trading here. What would be your bias? Where would you plan your trade? You're getting my point. I'm trying to make this topic like I just want to simplify it, because people are spending hours and hours and hours of doing the analysis, and coming up with a bias and speculating the price to go upwards or downwards. But your approach is very, very, like you can say, I find it to be very complicated, to be honest and frank. The reason being said is that 1 hour would go in a certain direction, 15 minutes would go in a certain direction, and 4H would go in certain direction. They have their own pulse, they have their own momentum, they have their own range, they have their own spread. They move in the accordance with the you can say candle which has been formed on 4 hour. So volatility, momentum, price action, volume, everything differs from time frame to time frame. So what happens? So at some degree, you would find a accumulation or a distribution on higher time frame, and in some certain cases, you would be successful in identifying accumulation and distribution on lower time frame as well. But that doesn't mean it will be very like they would collaborate with each other, or they would sync in with each other. That's the reason people face difficulty. Then to resolve this, get the solution for this difficulty, they try to focus on single time frame. Like for example, again I'll take an example of 15 minutes. They only try to identify schematic. This is the third resort which they come to. First one is either they are trading based on this 1 hour time frame analysis and planning the trades around this particular level, looking for schematic on lower time frame. Second thing, they are trying to sync this one with a lower time frame or higher time frame. Third resort, they come up with this like now we would only focus on one time frame and try to identify schematic. So the problem is you would find, because these are the major phases within this like within this one schematic, there are hundreds or the like Like if this is a monthly chart, there would be 100 schematic. If this is a weekly chart, there would be tens of schematic. So because every price turn is either accumulation or distribution. So to cater to this issue, what I have come up with is simplifying my trading because how and this same thing goes with accumulation. Now people will say you haven't touched on accumulation. If we are selling this same case, same example, if this is a 1 hour time frame, and I'm doing a schematic analysis on this one. Price is going above the creek and then like selling climax. Unlike buying climax, when it comes to selling, like when it price is coming down, we call it as selling climax. Secondary test, and then here we call it as utah, here we call it as spring. Sometimes to some degree there would be a test of the spring, and to some degree there would be a test of utah as well. It is like I've seen it quite often that springs are also tested and often upthrusts are also tested. But after that, what happens? The price jumps across the creek, that means this one creek, and we are drawing this creek around the automatic reaction or automatic rally as we are drawing the ice from automatic rally or automatic reaction, whatever you want to name it. So again, here also there are the three ways to trade based on this schematic phase analysis. Either you're doing your analysis and planning your trades on every twist and turn. But how do you know this twist is going to come out and is going to come? There is one way you can assess that this could if this is a automatic reaction. So I bet like I place my bet over here that price should be rejected over here. Okay, agreed. But having said that, you're doing it on 1 hour. How would you do it on 5 minutes? Because most of the trader they don't initiate trade over here or either over here because this is high speculative kind of thing. Because many people fail to trade on springs and upthrust because here it is not clear whether the price is going to like is going to go upwards or downwards. And here also it is not clear whether the price is going to go downwards or it would it continue from upwards. So having said that, here also most of the people they initiate trade after LPS. Agreed. Here also people will trade initiate after LPS. But the problem still remains that you're doing a higher time frame. Most of the traders they do higher time frame analysis, and then they drop down to 1 hour time frame, 5 minute or any trading time frame, 1 minute, 15 minute, and they try to get another schematic on that one, which would be of the same phases, and then they plan a trade. And when they correlate or coordinate or collaborate or try to sync any lower time frame with their schematic time frame, this is where the confusion arises. And this confusion would lead to what is the confusion? There would be a distribution schematic over here, there would be a accumulation schematic over here. Which one would you follow? Some would say higher time frame is the lead like is the time frame which would like on a longer run which would make the market move in certain direction. But to some traders they say lower time frame is the reflection like is the first time frame which would reflect trend change. So if this is showing you distribution and H1 is showing you accumulation, then how would you go sink in? And this happens. This is a practical problem. If you know accumulation how it works, then you should face this problem. If that is not the case, then I doubt whether you learned it properly or not. So to cater these issues, and moreover, there are many a times price would say is see V type correction or W type correction, or sometimes there would be only uh, one secondary test, and after that price would flow upwards, or either price there would be only like you can say you are in a phase A or halfway a phase B, only one test is there, and then no UTAR, no whatsoever spring price is going upwards. Then how would you define this as an accumulation? And how would you define if you are not getting any UTAR? So now you just get the point. This you're making your trading difficult by this doing so, and this will impact your trading psychology. And once your trading psychology is been affected, that means you would not be in a you would not be in a position to understand